In this video, we're going to be discussing when interest is received or paid in advance. So in advance means that we are going to be paying interest or receiving interest for future periods. So we're going to be dealing at the same time with a loan on which interest is paid in advance, or an investment, an asset on which interest income is received in advance. So the first step is, what are the opening and closing capital balances? This is the first thing in any question you need to determine. At which date did the capital balance change? It might be more than one date. So if it's necessary to draw a timeline, I have a timeline here just to help us to understand this question. So we're going to start with an opening balance of 100,000 at the beginning of the year. After 5 months, it changes by 20,000 down to 80, and then the closing balance is 80 from that point onwards for 7 months till the end of the year. This is what the general ledger account would look like if we were dealing with a loan, which is a liability, which reduces on the 31st of May. And then from that point onwards, it becomes 80,000. There would be interest owing and interest expense on the loan. And if we had an asset, then it would have a debit balance, which reduces because we've made a payment, we've received 20,000. So the asset is reduced by 20,000. So we would have debited, bank credited the asset. So from 31st of May onwards, the asset balance would be 80,000. So at this point, we could already work out the interest, because we would work out interest on 100,000. If the interest is 10%, that would be for 5 months. 4167 would be your interest. And then for 80,000 for 7 months, the interest would be 4667. So the interest for the year would be 8834, and that's what you would show as either your interest expense or your interest income on your statement of profit and loss. So the next step is, which dates is interest paid or received? So we need to look at for which period is the interest, how often is interest paid during the year, and on which dates. So in this question, we're going to say that interest is paid for 4 months at a time, but it's being paid for the following 4 months. So 1 month before the end of the year, interest was paid until 3 months into the following year. So that would be 1 month of the current year, 3 months of the following year, interest is paid for that 4-month period. Then it's paid for the following 4-month period, 2 months before the balance changes, 2 months after. So we'd have to take that into account when we calculate the interest, and then paid for the following 4 months, and then the following interest is paid for 4 months, of which 1 month would be in that financial year, 3 months in the following financial year. So each time interest is being paid in advance, or interest is being received in advance if we have an asset, but it's being received for the following 4-month period. So now we're going to calculate how much interest was paid or received in advance at the end of the year. So we're going to look at the end of the previous year first. So here we had interest paid 1 month before the end of the previous year. So that means at that point, interest would have been prepaid for these 3 months. Just want to get the right pointer out here. So the interest would have been paid for these 3 months over here. So that's a prepayment. We've paid interest for the 4-month period. So we're going to work out the prepayment of 100,000 times 10% for 3 months. That those 3 months, and that is the interest for those 3 months, would be reflected when we reverse our prepayment that we will record. The adjustment we can record on the end of the previous year, we're going to reverse at the beginning of the next year, and that will then reflect the interest for those 3 months. Then we go to the end of the year, and we will have interest prepaid again, and that will be interest prepaid for the next year for 3 months. So the interest payment we make here, 1 month relates to this year, but 3 months relates to the next year. So that means we'll be making a payment of which 3 months is going to be prepaid. So in our general ledger accounts, if we're working with a year going from 1st of January to 31st of December, at the end of the previous year, there was 3 months prepaid. That means our balance, we're assuming, was 100,000. 10% for 3 months because balance hasn't changed yet. It only changes 5 months into the current year, the 31st of May. So this interest payment at the end of the year is prepaid. The interest was paid already for January to March. So we have a balance on this asset account because last year we would have reversed the interest expense. We would have credited the interest expense and debited the prepaid interest expense account. And if we had interest income received in advance last year, we would have done a journal entry where we debited interest income and credited interest income received in advance. So at the end of November 2021, we would have received the interest for the whole 4 months, and this is the 3 months interest that would have been reversed out of interest income and shown as interest income received in advance. So then at the 1st of January, we're going to reverse the adjusting journal entries that were done at the end of December. So now we're going to take the prepaid interest expense, we're going to credit that expense, and we're going to debit the interest expense. So that's the reversal of the interest expense prepaid for January to March 22. And that means we're now showing it as this year's interest expense. And if there was interest income that was prepaid, we're now going to reverse the interest income liability. That's the interest income received in advance. We debit the liability and we show the 3 months now as interest income for the current year for January to March 22. So this is what the general ledger accounts would look like for interest paid. So the prepaid interest expense is being reduced. And the interest income in advance, if we're talking about a liability, an asset on which interest income was received in advance, we're now reversing that interest income received in advance. And the other side of the entry, if we're talking about the interest expense on the loan, we're going to be debiting the interest expense with the interest for January to March, and we're going to be crediting the interest income with the interest for January to March. So this is the journal entry that we posted, reversing last year's adjusting journal entry. We're reversing it on the 1st of January, and we're showing the prepayment for last year. We're showing that as interest expense. And if we had an asset on which interest income was received in advance, we're reversing that and showing it as interest income for this year. So the next step is to then work out what the interest prepayment is at the end of the current year. We've just done what the interest reversal would be at the beginning of the current year. So now we're going to the end of the current year. So we would need to do an adjusting journal entry at the end of December 22, because remember we would have made a payment on the 30th of November, 1 month before the end of the year, for the following 4 months, of which 3 months would be in the next financial year. So we've prepaid the interest for January to March 2023. So we need to take that 3 months interest out of our interest expense account, and we need to debit that as an asset. It's a prepaid interest expense amount, which is an asset. So that's on a loan balance of 80,000, 10% for 3 months. It's 2,000 Rand interest for January to March. And if we had an investment, it means on the 30th of November 2022, we would have received interest income for the next 4 months, 3 months being in the next financial year, January to March. So we have to take the interest income that we received out of the interest income account. We debit the interest income and show that as interest income received in advance. It's a liability at the end of December 22. It's amount of interest we've received for the next 3 months. So in my general ledger account for the interest expense incurred on the loan, I would now at the end of the year have a 2,000 Rand balance in my prepaid interest expense account, and then in the interest expense account itself, that 2,000 Rand would get taken out on the credit side. So that's the interest expense for the following year, January to March 2023. So this is what the general ledger account would look like for an investment on which interest is being earned. we would have at the end of the year on our interest income received in advance account, which is a liability, we would have the interest income that's been received for January to March 2023. And in my interest income account on the debit side, I would have the £2,000 interest income that was received for January to March 2023. So that's been taken out of my interest income account. So that's the posting of the general journal entry, the adjusting entry that I did at the end of December for the interest income received in advance. That's what it looks like in the ledger accounts. So then the final step is that you might need to calculate the amounts of the interest payments or receipts during the year. So that means you're now going to be actually needing to work out what is the interest that gets paid every time. So the first interest payment, 1 month before the end of the year, that would have been on R100,000 for that period. But now this one here, 3 months into the year, the next 4 months, the balance changes. So we'll be paying interest on the balance of 100,000 for 2 months, and then interest on the balance of 80,000 for 2 months. For this interest payment here, the balance doesn't change. It's 80,000 for 4 months. And here again, the balance doesn't change, so it's 80,000 for 4 months. So now let's go and process the journal entries for that. So if we're dealing with a loan and interest expense, on the 31st of March, we'll be paying interest for April to July. So for April and May, the balance is 100,000. Interest is on 100,000 for 2 months. Then for June and July, the balance reduces to 80,000. So that's for 2 months. So if we add those two amounts together, the interest expense is 3,000 for April to July. Then on the 31st of July, you're paying the interest up till the end of November. The balance is 80,000 for those 4 months. The interest expense is 2,667. Then on the 30th of November, you're paying the interest for December to March 2023. The balance is 80,000. So that's the balance hasn't changed. That's why the interest expense is the same as it was for the previous 4 months. This is what the general ledger accounts would look like for posting those interest payments on the loan. So remember, we have the prepaid interest expense that was paid last year. That was our reversal of last year's adjustment. We now have the interest expense showing for January to March 22. So it was paid last year, but it had to be shown last year as an asset. And this year then the asset got reversed to the interest expense account. Then we made a payment on the 31st of March for the next 4 months, April to July. Then on the 31st of July, we paid August to November. And then on the 30th of November, we paid December 22 to March 2023. Then we did an adjusting journal entry where we took out the interest for January to March 2023, and we showed that as a prepaid interest expense. And the amount then, the difference between the debits and the credits, gives me the the amount of the interest expense for the period that will go to the profit and loss account. And that is the same amount that we worked out earlier on. That's the 8834 interest expense. Then if we had an asset on which we were earning interest income, this is the receipts that we would receive. On the 31st of March, we receive interest for the next 4 months. And remember, the balance changes 5 months into the year, which is the end of May. So we receive interest for 2 months, April and May, on 100,000. Then we receive interest on 80,000 for June and July. So we debit bank credit interest income with 3,000. Then on the 31st of July, we receive interest for August to November. That's 2,667. And then on the 30th of November, we receive interest for December 22 to March 2023. So that means we're receiving 3 months for next year, and the total we receive is 2,667. So this is what the general ledger accounts would look like if we have an investment on which interest is being earned. On the interest income account on the credit side, last year we received this 3 months interest, but at the end of last year we would have taken this out of the interest income account and showed it as interest income received in advance. Then the beginning of this year, we reversed that back into interest income. So that's the interest income for January to March. Then we receive the interest income for April to July. Then the interest income for August to November. Then we receive the interest income for December to March. So that's 2667, but included in there is the January to March interest income. So I've taken that out and shown that as interest income received in advance. So the beginning of the next year, I will reverse it like I did at the beginning of the current year. So the amount then of the interest income, if I take these the credits, and I subtract the debit, that is my interest income received for the year, which I'm going to show as interest income in my statement of profit and loss.